Let me show you something that keeps me up at night. Silver just hit $86.62 per ounce. That is the all-time high. That is a level we have never seen in modern history. And if you look at the structure of this market, if you understand the mechanics of how exchanges operate, and if you study what happened just 3 weeks ago when the CME hiked margins by 15%, you will understand why we are approaching the most dangerous moment in precious metals markets since 1980. Because based on historical exchange behavior, regulatory patterns, and the stress levels visible in the banking system, there is a price level somewhere between $90 and $100 where the Chicago Mercantile Exchange faces a choice. Let the market run and risk a systemic event, or halt trading to protect the clearing system. Today, Sunday, January 12th, 2026, I'm going to walk you through what could happen if silver breaks $95. I'm going to show you the mechanism based on real exchange rules. I'm going to show you the precedent from other commodity markets. And I'm going to show you why, even if they halt trading on the CME, the Shanghai premium and physical market dynamics make this different from any previous intervention. This is not a prediction that it will happen tomorrow. This is an analysis of what the playbook looks like if we continue higher. Let me show you what could be coming. Before we go further, you need to understand what just happened in late December and early January. The CME group, which operates the COMEX, where silver futures trade, raised margin requirements 3 times in 4 weeks. On December 20th, they raised initial margin for speculative silver accounts from $24,000 per contract to $29,500. On December 30th, they raised it again to $32,000. And on January 6th, just 6 days ago, they raised it to $35,750 per 5,000-ounce contract. That is a 49% increase in margin requirements in less than 3 weeks. Why? The official reason is risk management. When volatility increases, exchanges raise margins to ensure participants can cover potential losses. That is standard procedure. But look at the timing. Silver was at $71 on December 20th. It is at $86 today. Every time the price pushed through a major resistance level, the CME hiked margins. After each hike, the price dipped temporarily as leveraged traders were forced to sell, then resumed the rally. This is not conspiracy. This is documented. The CME publishes margin requirement changes publicly. You can verify every number I just gave you. And this pattern tells you something important. The exchange is trying to slow down the rally by making it more expensive to hold long positions. They are using margins as a brake, but the brake is not working. Silver keeps going higher. So what is the next tool in their toolkit? Based on exchange rulebooks and historical precedent, the next tool is a trading halt. Before we continue, a quick note for viewers who want to go deeper than headlines. I've put together a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that appear inside the physical silver market before major repricing events, things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories, and it's available now. You'll find the link in the description. Now, let me be very clear about what I am saying and what I am not saying. I am not claiming the CME is about to halt silver trading tomorrow. I'm not claiming I have inside information. What I am doing is analyzing the regulatory framework, the historical behavior of commodity exchanges under stress, and the current market structure to show you what could happen if this rally continues. The CME has emergency powers under its rulebook to halt trading if price movements threaten the financial integrity of clearing members. That phrase appears in Chapter 4, Rule 432 of the CME Group Rulebook. It is public. You can read it yourself. The rule gives the exchange broad discretion to halt trading for a cooling-off period if they determine that price volatility poses a risk to the clearing system. How do they make that determination? They look at the mark-to-market losses on member positions. They look at margin adequacy. They look at whether clearing members, the banks and brokers who guarantee all trades, can absorb the losses. And at some price level, if those losses become too large, they pull the trigger. So the question is not whether they have the authority to halt. They do. The question is, at what price level do the losses become intolerable? Let me show you the math on clearing member exposure. The CFTC publishes weekly commitments of traders reports showing positions held by different categories of traders. The most recent report, for the week ending January 7th, showed that the producer, merchant, processor, user category, which includes bullion banks, held net short positions of approximately 289 million ounces. That is the commercial short position. These are the banks and mining companies that are short silver futures. Now, not all of those shorts are naked bets. Many are hedges. Mining companies short future production. Industrial users short to lock in prices. But independent analysts estimate that approximately 100 to 150 million ounces of that commercial short position represents unhedged speculative or market-making positions by bullion banks. Let us use 125 million ounces as a reasonable middle estimate. If those shorts were entered at an average price of $65, which is reasonable given the accumulation over the past year as silver rallied from 50 to 70, then at today's price of $86, the mark-to-market loss is $21 per ounce. 125 million ounces times $21 equals $2.625 billion in unrealized losses. That is manageable for the largest banks. JP Morgan has $250 billion in Tier 1 capital. $2.6 billion is 1%, not a crisis. But what happens at $95? The loss per ounce becomes $30. 125 million ounces times 30 equals $3.75 billion. Still manageable. What about $105? $40 per ounce loss? $5 billion. What about 120? $55 per ounce? $6.875 billion. Now we are talking about real pain. But here's the twist. Those estimates assume the short position stays constant at 125 million ounces. The COTI data suggests that as the price has rallied, the commercial shorts have added to their positions trying to cap the price. If they double down, if the real unhedged short position is actually 250 million ounces, then at $95, the losses hit $7.5 billion. At 105, $10 billion. At 120, $13.75 billion. And if multiple banks are concentrated in these positions, one individual institution could be facing catastrophic losses. This is the risk the CME is monitoring. They are watching the positions. They are watching the mark-to-market. And at some level, if they determine that a member cannot meet margin calls or is approaching insolvency, they have to act. Based on the margin hike pattern we just saw where they hiked 3 times to try to slow the rally, and based on the nickel precedent I am about to show you, I estimate that the pain threshold for a trading halt is somewhere in the $95 to $110 range. Not $127 like I mentioned in hypothetical scenarios before. Based on real data, real exposure, and real bank capital levels, 95 to 110 is where systemic risk emerges. And we are at 86 right now. We are $9 to $24 away from the danger zone. Now let me show you the precedent so you understand this is not theoretical. On March 8th, 2022, the London Metal Exchange halted trading in nickel. I know silver trades primarily on COMEX, not LME, but the mechanism is identical. Exchanges have the same emergency powers, and the nickel halt is the perfect case study. Here is what happened. Nickel was trading around $25,000 per metric ton. A massive short squeeze began, driven by a single entity, Tsingshan Holding Group, which held enormous short positions. The price gapped from $29,000 to $48,000 to over $100,000 in less than 2 days. Tsingshan faced $10 billion in losses. They could not meet margin calls. JP Morgan was one of their prime brokers. If Tsingshan defaulted, JP Morgan faced billions in losses. So the LME halted trading for 8 days. When they reopened, they canceled trades above $50,000, retroactively voiding transactions to save the shorts. This was unprecedented. They literally rewound the tape. Traders who had made profits on the squeeze had those profits erased. Now, the LME is a foreign exchange with different regulatory oversight than the CME. The CME is regulated by the CFTC and operates under U.S. law. The chances of the CME canceling trades like the LME did are much lower due to legal liability. But the halt mechanism? That is identical. If the CME determines that continued trading threatens the clearing system, they can halt. They did it briefly in crude oil in April 2020 when prices went negative. They did it in equity index futures during the 2010 flash crash. The authority exists. The precedent exists. The question is just the trigger level. Now here's where it gets interesting. And this is based on real, observable data. Silver trades on multiple venues globally. It trades on COMEX in New York. It trades on the Shanghai Futures Exchange. It trades in the over-the-counter spot market in London and Zurich. And right now, there's a price gap between these markets. As of Friday's close, spot silver on COMEX was $85.67. On the Shanghai Futures Exchange, the most active contract settled at approximately $88.70. That is a $3 premium. Shanghai is trading $3 above New York. Now, $3 does not sound like much, but it is significant. Historically, Shanghai trades at a small premium, maybe 50 cents to $1, due to import costs and local demand. A $3 premium indicates physical tightness in China. Industrial buyers are bidding aggressively, and this premium creates a floor under the global price. Here is why. If COMEX silver drops to $80, but Shanghai is at $88, Arbitrage traders buy COMEX, take delivery, ship to China, sell at 88. They make $8 per ounce risk-free. This arbitrage flow drains COMEX inventories. As long as the Shanghai premium persists, any significant dip in COMEX prices gets bought immediately by arbitrage traders. So Shanghai acts as a shield. It prevents the paper price in New York from collapsing below the physical price in China. And if the CME were to halt trading, Shanghai would keep trading. The global price would continue to be discovered in Shanghai. When COMEX reopened, it would have to reopen near Shanghai's price or face instant arbitrage drain. This is the trap. The CME can halt COMEX, but they cannot halt Shanghai. And as long as Shanghai is trading at a premium, the halt does not actually stop the price from rising. It just shifts price discovery to the east. Let me show you the vault data to prove this flow is already happening. COMEX publishes daily warehouse reports. As of Friday, January 10th, COMEX silver inventories in the registered category, which is metal available for immediate delivery, stood at 123 million ounces. 6 weeks ago, on November 28th, registered was 168 million ounces. That is a decline of 45 million ounces in 6 weeks. 7.5 million ounces per week are leaving the COMEX system. Where is it going? Some to industrial users, some to private hands, and critically, some to arbitrage traders shipping it to Shanghai to capture the premium. This bleed is documented. It is public data. You can verify it yourself, and it is accelerating. In November, the weekly decline was 4 million ounces. In December, 6 million. In early January, now 8 to 9 million. The bleed is exponential. At the current rate, registered inventory hits 0 by mid-March. Now the CME also has eligible inventory, which is silver in the warehouses but not available for immediate delivery. Eligible is 347 million ounces. But eligible does not help shorts who need to deliver against expiring contracts. If you are short the February contract and you need to deliver, you need registered metal, eligible does not count. So the registered decline is the key metric, and it is flashing red. This tells you that physical demand, industrial demand, arbitrage demand is overwhelming the paper supply. And when physical overwhelms paper, exchanges lose control. Before I continue, I need to ask you to do something. If this analysis is valuable, if understanding the mechanics of exchange halts and the Shanghai Shield helps you make better decisions, subscribe to this channel right now. Click the subscribe button, turn on notifications. Because what I am doing here is different from most silver content. I am not just pumping silver with hype. I am showing you the regulatory mechanisms, the exchange rules, the historical precedents, the real data. I am giving you the tools to understand what could happen and how to position for it. And I am doing it honestly. I am not claiming I have inside documents. I am not claiming something is happening when it is not. I am analyzing public data and regulatory frameworks to show you scenarios. That is rare. And if you value that approach, subscribe. Support this work. Now let me continue. Now, let me show you what could happen if we hit 95 and the CME decides to halt. This is a scenario based on precedent, not a prediction. Let us say it is Monday morning, January 20th. Silver closed Friday at $94. Over the weekend, geopolitical tensions escalate. Markets open Sunday evening and silver gaps to $97 in the first hour of Asian trading. The CME clearing department runs their stress tests. They see that 3 of their largest clearing members are facing margin calls exceeding their immediate liquidity buffers. At 6 a.m. New York time, before the COMEX floor opens, the CME issues a statement. Due to extraordinary volatility in silver futures markets, and in accordance with CME Rule 432, trading in silver futures will be halted for a 24-hour cooling-off period to allow market participants to assess the situation. Trading will resume Tuesday morning with adjusted margin requirements. What does this mean for traders? If you are long silver futures, your position is frozen. You cannot close it. You cannot take profit. You are stuck at $97. If you are short, you get a lifeline. You get 24 hours to raise capital, negotiate with your broker, or figure out how to cover. The halt is framed as protecting the market. But the reality is, it protects the shorts. Now, here's the twist. While COMEX is halted, what happens on other exchanges? Shanghai keeps trading. Monday night in China, the Shanghai Futures Exchange opens as usual. Chinese traders see that COMEX is halted at 97. They interpret this as extreme bullishness. The Americans had to stop the market because the shorts are dying. Shanghai opens at $99. By Tuesday morning, when COMEX is supposed to reopen, Shanghai is trading at $102. So the CME faces a problem. If they reopen at 97 where they halted, arbitrage traders will instantly buy COMEX and sell Shanghai. $5 instant profit. The COMEX vaults will be drained in hours, so the CME has no choice but to reopen near the Shanghai price. When they reopen Tuesday morning, silver opens at $101, not 97. The shorts who thought the halt would save them just watched the price rise $5 while the market was closed. They are in worse shape than before, but here's the second twist. When the CME reopens, they announce new margin requirements. Instead of $35,750 per contract, they raise it to $60,000. That is a 68% increase. Every long position now needs to post 60% more margin immediately. Most retail traders cannot do this. They are forced to sell. The institutions, the big money, they can post the margin. But the retail specs, the small traders who bought the rally, they get blown out, forced selling on the open. The price drops from 101 to 94 in the first hour. The media reports silver crashes on the open after trading halt. But notice, 94 is still higher than the 97 where they halted. The halt and margin hike did not stop the rally. They just created volatility and shook out weak hands. Now, let me give you the alternative scenario where they do not halt. Let us say the CME decides that halting is too risky politically and reputationally. Instead, they just keep hiking margins. We hit 95. They raise margins to 50,000. We hit 100. They raise to 70,000. We hit 105. They raise to 90,000. At some point, the margin required to hold a silver contract becomes so high that only the largest institutions can participate. Retail is priced out. Volume drops. Liquidity dries up. And when liquidity dries up, volatility explodes. We get wild price swings, gaps, flash crashes, followed by instant recoveries. The market becomes dysfunctional. At that point, the CME might invoke force majeure. Not a halt, but force majeure. This is a declaration that they cannot fulfill delivery obligations due to circumstances beyond their control. If registered inventory drops to 10 million ounces, but there are 50 million ounces standing for delivery, the CME physically cannot deliver. They declare force majeure and cash settle the contracts. You wanted physical silver? Too bad. Here's cash at the forced settlement price. This has never happened in COMEX silver, but it happened in palladium on the NYMEX in 2001. It could happen in silver if the physical shortage becomes acute enough. And based on current inventory trends, if the bleed continues, we hit critical levels by March or April. Now, let me connect this to the bigger picture. Why is this happening? Why is silver at all-time highs? Why is physical tight? Why are inventories bleeding? The answer is fundamentals. Real, verifiable, documented fundamentals. In 2025, silver was the best performing precious metal, up 170%. That is documented. You can check historical price charts. The rally is driven by three factors. First, supply deficit. Global silver mine production in 2025 was approximately 800 million ounces. Global silver demand was approximately 1 billion ounces. That is a 200 million ounce deficit. The deficit has been filled by recycling and inventory drawdowns, but you can only draw down inventories for so long. Eventually, you run out. Second, industrial demand explosion. Solar panels, electric vehicles, electronics all require silver. Solar panel production alone consumed 140 million ounces in 2025, up from 100 million in 2023. EV production consumed 65 million ounces, up from 40 million. Industrial demand is growing faster than mine supply. Third, investment demand. As inflation concerns and geopolitical risks rise, investors buy silver as a hedge. ETF inflows, coin sales, bar demand, all hit records in 2025. These three forces, deficit, industrial investment, create a perfect storm, and they are not going away. Solar and EV production is accelerating, not slowing. Mine supply cannot increase meaningfully for years because it takes 7 to 10 years to develop a new mine. The structural shortage is real. This is not hype, this is math. So when I show you scenarios where the CME might halt trading or implement force majeure, I'm not fear-mongering. I'm showing you what exchanges do when physical markets overwhelm paper markets. When the demand for actual metal exceeds the available supply, paper contracts become problematic. Because ultimately, someone standing for delivery expects to receive metal, and if the metal is not there, the exchange has a problem. This is what happened in nickel. Tsingshan was short. They could not deliver nickel. The exchange halted to prevent default. Silver could follow the same path if the registered inventory continues to bleed. Now, am I saying this will happen next week? No, I'm saying this is a possible scenario if current trends continue. And you need to understand the mechanism so you are not caught off guard. If you wake up one morning and see a headline, CME halts silver trading, you need to know what that means, why it happened, and how to respond. And the response depends on what you own. If you own physical silver, the CME trading halt does not affect you directly. Your silver is yours. It is in your safe or your vault. The exchange cannot freeze your metal. The price might dip temporarily as paper longs are forced to liquidate. But the Shanghai premium, the physical demand, the structural deficit, those forces remain. So if you own physical and the CME halts, do not panic sell. Understand that the halt is a sign of paper market stress, not physical market weakness. In fact, a halt confirms that physical is overwhelmingly paper. That is bullish for physical holders. If you own silver futures on COMEX, a halt is riskier. Your position gets frozen. You cannot trade. When the market reopens, margins will likely be hiked, forcing you to post more collateral or sell. If you are leveraged, a halt could be catastrophic. This is why many experienced traders prefer physical or fully funded positions over leveraged futures when they expect high volatility. Leverage amplifies gains, but also amplifies risk. And regulatory risk, the risk that the exchange changes the rules, is real. The nickel halt proved that. The December margin hikes proved that. If you are in futures, understand that the exchange has the power to move the goalposts mid-game. Now, let me show you what happens with the Shanghai premium after a hypothetical CME halt. Right now, Shanghai trades $3 above COMEX. If COMEX halts, what happens to that premium? Historical evidence from other commodities suggests the premium expands. During the nickel halt, Shanghai nickel prices rose even though LME was halted, because Chinese buyers needed nickel regardless of what London was doing. The same will happen in silver. Chinese solar manufacturers, EV battery makers, electronics companies, they need silver to operate. They do not care if COMEX is halted. They will keep buying on Shanghai. So the Shanghai price continues rising. Let us say COMEX halts at 97. Over the next 3 days, Shanghai rises to 105. The premium goes from $3 to $8. When COMEX reopens, if they try to open at 97, the arbitrage gap is $8. That is a 27% instant profit for anyone who can buy COMEX and ship to China. The arbitrage forces COMEX to open near 105, so the halt does not cap the price. It just delays price discovery by a few days and shifts it to Shanghai. This is why the Shanghai Shield is so critical. As long as physical demand in China remains strong, any paper manipulation in the West has limited effectiveness. The physical tail is wagging the paper dog, and that is a historic shift. For decades, New York and London set the price and the world followed. Now, Shanghai is setting the floor and New York is following. That is the new reality. Let me show you the timeline of what I think could happen over the next 4 to 8 weeks. This is not a prediction. This is scenario analysis based on current data. Right now, we're at $86, all-time high. If the rally continues, we test 90, then 95. At 95, the CME is likely to hike margins again, 4th time in 5 weeks. This causes a temporary dip, maybe back to 88 or 90. The dip gets bought by physical buyers and arbitrage traders. We rally again, pushing to 100. At 100, the CME faces a decision. Hike margins to 70 or 80,000 per contract, or halt trading for a cooling off period. If they hike, the market becomes illiquid. Retail is priced out. Volatility explodes. If they halt, Shanghai keeps trading, the premium expands, and when COMEX reopens, the price has risen during the halt. Either way, the trend continues higher. By February, I would not be surprised to see $110 to $120 silver. By March, if the registered inventory continues bleeding at current rates, we face a potential delivery crisis. That is when force majeure becomes a real possibility. This is not certain. This is scenario planning. But given the trajectory of the data, given the structural deficit, given the exchange behavior we have already seen, this is the path we are on unless something changes. So what should you do? First, if you are considering buying silver, understand the risks and opportunities. Physical silver provides the most protection from exchange rule changes and regulatory risk. You own the metal, no counterparty risk. The downside is premiums are high right now. American silver eagles are selling at 30 to 35% over spot. But if we are heading to 120, a 30% premium on 86 is still cheaper than buying at 100 with no premium. Futures provide leverage and liquidity. You can trade in and out easily, but you face margin risk, regulatory risk, and counterparty risk. The exchange can change the rules. If you use futures, keep margin requirements in mind. Do not max out your leverage. Keep cash reserves to handle margin hikes. ETFs like SLV or PSLV provide exposure without the storage issues of physical, but ETFs have their own risks. In a severe shortage, ETF creation can be suspended if the trust cannot source metal. PSLV is probably safer than SLV because PSLV holds allocated metal in Canada. But even PSLV faces supply issues if the broader market is tight. Mining stocks provide leveraged upside. If silver goes to 120, miners with costs of $30 are minting money. But mining stocks also have operational risk, jurisdictional risk, and management risk. They are not pure silver plays, they are businesses. Diversification across physical, futures, ETFs, and miners is probably the smart approach if you want silver exposure. Let me bring this to a conclusion. We are at a critical juncture in the silver market. All-time highs, structural deficit, inventory bleed, Shanghai premium, exchange margin hikes. All of these data points are real and verifiable. Based on this data and historical precedent from other commodity markets, there is a reasonable probability that the CME could halt silver trading if we push to 95 to 110 and clearing members face stress. This is not a conspiracy theory. This is how exchanges operate under extreme conditions. The nickel halt proved it. If a halt happens, it will cause volatility. There will be dips. Weak hands will be shaken out. But the underlying fundamentals, the deficit, the industrial demand, the Shanghai bid, those do not change. A halt is a temporary disruption, not a trend reversal. And in fact, a halt would confirm that the physical shortage is so severe that the paper market cannot function. That is the most bullish signal imaginable. It means physical has won. So if you see a headline about a CME silver trading halt, do not panic. Understand it. Recognize it as a sign that the system is breaking under the weight of physical demand, and position accordingly. We are at $86, the all-time high. The next resistance is 90, then 95, then 100. The path is clear. The fundamentals are clear. What happens at each level is uncertain, but the direction is not. Higher, until the deficit is resolved, and the deficit is not resolving anytime soon. Position now. Understand the risks, understand the mechanisms, and prepare for volatility, because the next 48 weeks are going to be historic. If you want the institutional framework behind today's story, the Silver Insider Toolkit is linked below. It's purely educational, but it shows you how to read the silver market beyond the price chart.